Hello, everyone. Risk management and how you're supposed to trail your stop loss once your take profit hits. So, whether you're trading stocks, crypto, or forex, whichever market you're trading in, the most important element of these markets is how you're going to manage your risk. If your risk management is not correct, then in the longer term, you will not have a win position. So, to put that into perspective, let's look at this example. Let's go to the whiteboard here. And let's say that our starting capital is $10,000, which is also the capital with we will be doing the trade, right? So $10,000 I'm going to have to put into one single trade. And if my leverage for that particular trade is, let's suppose, 5x, and my stop loss is at 5%, or let's say 7%. So what happens is if my stop loss hits, I'm down 35% or $3,500. Now my end result for the trading portfolio, I'm just left with $6,500. Now what's going to happen is with this $6,500, firstly, I will be very demotivated because I'm down 35%, right? Which is a big amount of money. And I'm just left with 65% of my portfolio. Now, if I have to bring this portfolio back into $10,000, so what am I supposed to do? I'm supposed to make back $3,500, right? To break even. So $3,500 on $6,500 means that I'm at least looking at about 50 to 60% of a profit in one or two trades, which is, I wouldn't say it's not doable. It is doable, but it is very difficult to achieve in one or two trades, right? So that's basically when risk management comes into play. Now, if instead of 5x, you had taken, let's suppose, 2x leverage, and your stop loss would have hit. So you're talking about a 14% loss, which is about 14% loss, or $1,400 would have been your loss, and your portfolio would be standing at $8,600. Now, to bring back this amount back to $10,000, you just have to have $1,400 and $8,600, which is almost 15 to 18% in one trade. So you see the difference. Over here, we are saying that just have 15 to 18% in one or two trades, and you'll be back to break even. And over here, we're saying that we need to have 50 to 60% to break even. So that is where the risk management comes into play. That is, if you do not define your risk before entering into a trade, then you will be screwed in the long run for sure. So you have to define your risk. That is, this is my portfolio. This is how much I'm gonna put it into one single trade, and this is what I can afford to lose, so that I am profitable in a long run on a consistent basis. If your risk management is not correct, then your account will be wiped out all the time. I have seen people using crazy leverage like 20x, 30x, 40x, or 10x, 11x, 12x, and so on and so forth. But the issue is that the issue with these things happens that when you hit the stop loss, it just wipes out your account. Now, yes, definitely the upside is more when you have a high leverage. If you hit a take profit, then you, let's say on 5x, you had a take profit of 10%, you make 50% instead of 20% on a 2x. But then again, in every single trade, there is a probability that the stop loss will hit. And that is why we have to be sure that we manage the risk accordingly. Okay? Now, this is on risk management. And if we go back here, how are you supposed to trail the stop loss? In my trades, what I do is I when I give you the take profit level. So for example, we had played out the sushi trade, and the take profit level was the TP1 was 1.45, which is this green line. Now, once the take profit hits, what you're supposed to do is that you are supposed to you are supposed to use this indicator called average true range indicator. Okay, and if I switch it off and then switch it on, it comes up like this. And then you can trail the stop losses on a 15-minute time frame. So let's say that our if we go back here, so this is where our take profit was triggered. This is TP1, and the moment TP1 hits, we close part of the trade because the rule is simple. You never give back the money back to the market because given the volatility in the market, you need to be sure that whatever money you have made, you have to exit this trade in a win position. Once the money is made, you never give that money back to the market. I have seen people going into a green position and then not booking profits, going back into a red position and then panic selling it and closing it in a loss position. So the rule is simple. The rule is when you think that your trade is worthy of taking a screenshot, that is the time that you should book some profits. Now, in this example, let's say that our take profit one was taken here. Now, if you would have gone onto a 15 minutes time frame and turn on this indicator, which is the average true range indicator, and then you can just trail your stop losses. Not with this line. You have to trail your stop losses underneath this line. So let's say over here, then once the price goes up, you can bring your stop loss here. Then when the price goes up, the accordingly the indicator is moving as well. You can bring your stop loss here, and then here, 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 and that's where our trade gets closed, right? So you can see that because of the trailing stop loss, you did make up an additional 4.42%. So if let's say you were using a 2x leverage, that's about 9% additional profit, right? So what I usually do, I would close about 25 to 50% trade here, and then if I have the time, if I can look at the charts from time to time, I would just trail the stop loss and let it run. That's how you maximize your profits. Because what is trading? Trading is just the game of where you need to maximize your profits and you need to minimize your losses, right? And then you'll be profitable in a longer run. Now, this is how you do it. And if I were to take another example of the trade that we recently had in our account, so this is DYDX, and for DYDX, TP1 was 2.85, TP2 was 3.075. This went parabolic, and both the TPs were hit within 2 hours. So if let's say we go back on the 15 minutes time frame, and okay, so this is what happened, right? So this is where the TP1 was hit, and the moment TP1 was hit, I would go ahead and I would trail my stop losses. Let's say my stop loss was here, then it was here, then it was here. The moment TP2 was hit, I have taken TP2 as well. Okay, so that's another on a 2x leverage. That's about 16% more, and then I would be trailing my stop losses accordingly. So then we go here after TP2, then we go here. That's when our entire trade gets closed. So you can see that we are maximizing on the profits and we are minimizing on the losses, right? Because the goal is to enjoy the entire wave, to ride the entire wave. So that's what we are focusing on. This is a very good indicator, and you could actually use it on all the time frames, but I usually use it in the 15 minutes time frame so that we can just book the profits and close the trade right away. Now, what happens is some people also go for EMAs, like for example EMA 21. Let me close this average true range indicator. So yeah, so some traders follow EMA 21 as a trailing stop loss as well. But so what they would do is when the target profit hits, they would just move the SL underneath the EMA, and then once it hits, right? But I have backtested this multiple times, but I have seen the average true range indicator gives you the maximum profit instead of any of the EMAs. So that's what I recommend as well. So if you have any questions or comments, you can just go ahead and type it type it in the video, and then I'll get back to you guys. Thank you.